financial accounting. Professor Morgan-Nance here. I hope you're having a great week, and I'm glad you're here too. Before we move into Chapter 1, I'd like to mention the intent of these video presentations. As you will discover, all of the topics in this course are covered in great detail in your textbook and in the optional interactive presentations and Learn Smart content in Connect. Accounting 301 requires that you take responsibility for and actively participate in your learning. As a result, my presentations are intended to supplement your reading and assignments rather than exploring the details of every topic. I will spend more time on some chapters and less on others. My goal is to review chapter material with you at a high level and spend our time together on the subjects that are the most challenging or important to your success in this course. The first 3 chapters in the course contain the foundation of everything else you will be learning during the semester. I strongly encourage you to invest the time it takes for you to learn the concepts presented in chapters 1 through 3. Without a firm understanding of those basics, you will have a difficult time passing the class. As always, if you have questions or trouble understanding a concept, send me an email or post a question on the chapter's discussion board. In Chapter 1, you will start learning about the language of business, accounting. The chapter is divided into roughly 4 parts: the background, the accounting equation, transaction analysis, and financial statements. The first chapter is an introduction of terms and techniques used throughout the remainder of the course and is an important foundation for your success in Accounting 301. Each chapter has several learning objectives, those things you should expect to know by the time you've completed the chapter and the related assignments. They are also presented in the Chapter 1 checklist. Accounting helps us tell a story of what happened to a company during a certain period of time, a month or a year, for example. We will write the company's story using the language of business, accounting. And we will learn how to interpret that story to make decisions about the future. The first 3 chapters in this course are devoted to learning to use double entry bookkeeping in the process of accounting. Accounting is called the language of business because all organizations set up an accounting information system to communicate data to help people make better decisions. We call this process we are learning the accounting cycle. We call it that because it ultimately results in financial statements, which is the story we want to communicate to our users. Accounting serves many users who can be divided into 2 primary groups: external users and internal users. Accounting 301, financial accounting, focuses on reporting to external users. Accounting 311, managerial accounting, focuses on reporting for internal users. External users of accounting information are not directly involved in running the organization and only have limited access to a company's accounting information. They include shareholders, creditors, and tax authorities like the IRS. Internal users of accounting information are those directly involved in managing and operating an organization, such as the Chief Executive Officer, the CEO, and the Chief Financial Officer, the CFO. The goal of accounting is to provide useful information for decisions. For information to be useful, it must be trusted. This demands ethics in accounting, and ethics are beliefs that help us distinguish right from wrong. They are accepted standards of good behavior. Ethics are very important in accounting. When a person or a company's ethics are not strong, they may be tempted to commit fraud. Now, the fraud triangle is a model created by a criminologist that asserts the following 3 factors must exist for a person to commit fraud: opportunity, pressure, and rationalization. Please read more about the fraud triangle in the textbook. In 2002, Congress passed the Sarbanes-Oxley Act to help curb financial abuses at companies that sell their stock to the public. SOX was landmark legislation and very expensive to implement. Results include more transparency, accountability, and truthfulness in reporting transactions. Your textbooks include a listing of some of the more publicized accounting scandals in recent years. A business entity can take one of three legal forms: a proprietorship, partnership, or corporation. We will be focusing on accounting for corporations in this course. For those of you who took Accounting 101, college accounting, you would have learned a slightly different form of accounting and that for proprietorships. Please review the primary characteristics of each of these types of organizations in your textbook. The rules that govern everything we record and report in accounting are called Generally Accepted Accounting Principles, or GAAP for short. You'll hear me talk about GAAP throughout this course. The purpose of these rules is to ensure that the users of financial statements can rely on them to make decisions about a company in the future. For example, investors use the financial statements to evaluate whether to buy a company's stock. Similarly, lenders evaluate whether they trust the company to pay back money borrowed. GAAP aims to make information relevant, reliable, and comparable. More definitions for each of these terms are found in your textbook. Two entities in the United States set accounting rules for companies that issue stock to the public: the SEC and the FASB. The Securities and Exchange Commission, SEC for short, is a governmental agency that is the enforcer of the rules. You have probably heard about the SEC giving fines and bringing criminal cases. The Financial Accounting Standards Board, the FASB, is a privately elected board to which the SEC has delegated rulemaking authority. International standards for over 115 countries are set by the International Accounting Standards Board, also known as the IASB. We call the International Financial Reporting Standards IFRS for short. IFRS tend to be more general in nature, we say principle-based, than U.S. GAAP, but often the two are very close. Accounting principles and assumptions govern the way we write down and report every business transaction in the accounting records. 4 principles and 4 assumptions are discussed in this chapter, and they are very important to understand because they are the foundation for everything we will learn. The revenue recognition and the matching principles are the 2 most important principles you will learn in this class. Please read about the measurement principle and full disclosure principle in your textbook, as I will not be discussing them separately here. Under the revenue recognition principle, revenue is recognized when earned. This usually occurs when services are performed or a seller transfers ownership of products to the buyer. The matching principle, also called the expense recognition principle, requires that a company record the expenses it incurred to generate the revenue reported. For example, if a company rents an office, it must match the cost of renting the office in August with the revenue recognized in the month of August. Of the 4 accounting assumptions, the most important for you to understand now is the business entity assumption. It states that the transactions of a business are kept separate from those of its owner or any other company. To commingle money between an owner and his business would result in distorted financial information. The records of a business should only include those transactions of the business itself. Please review the going concern, monetary unit, and time period assumptions in your textbook reading. They are also an important part of the foundation we are building in this chapter. Okay, so that's it for now, and see you in our next discussion about the accounting equation.